In this video, we are going to go over Tesla's stock as of Q4 2020, which includes the full financial year for them. The data in this video comes directly from their 2020 annual report on Form 10-K. Make sure you watch this video until the end to get our proprietary intrinsic value range, which is really the important stuff. If you enjoy this video, please don't forget to like, subscribe, and even hit the bell icon to get notifications sent to you whenever I upload a new video so you get this information in a timely manner. When it comes to investing, timely information can be critical. As for business, Tesla has two segments. They keep it nice and simple, and this makes it easy for us to analyze this company. The first segment is automobile, and this is manufacturing their cars, SUVs, etc. Their second segment is energy, and this consists of solar energy, energy storage, aka batteries, and services for repairing and installing these products. The automobile segment is definitely the majority of their revenue, coming in at 95%. This makes Tesla a concentrated company and gives them a strong core, and this is a good sign when you're looking at a company. Okay, let's talk about properties and gigafactories now. This photo is Tesla's gigafactory in Berlin, Germany. That is just one of multiple gigafactories. Here's a quick snapshot of all of Tesla's plants. Notice how some are owned versus leased. This leasing can give tax benefits and some financing to save cash flow. The asterisk that you see next to the Shanghai gigafactory, that's signifying that they own the building and the land use rights with an initial term of 50 years. So that's basically owning it as far as we care economically. Obviously, this doesn't include all of their dealerships and charging stations. This is just their primary manufacturing facilities. You may have a dealership near you. Obviously, those aren't going to be on this table. Now, for financial health, this current and quick ratio is better than expected with all the hate that you used to hear Tesla getting in the media about being so debt heavy and not having any positive free cash flow. So anything above 1 is usually a good sign, and they're well above 1 even in the quick ratio. The goodwill and intangible over assets is one of the lowest I've ever seen, actually, at 1%. Had to double check it just to make sure, but this just shows that the assets on their balance sheet are actually real tangible assets. Debt is in a decent range for a growth company with growing free cash flow, 49.25% compared to equity. I'm okay with that in the case of Tesla. Tangible book value per share comes in at $24.18, so theoretically, if they went bankrupt, there would still be a residual value of $24.18 per share. For accounts receivable, when it comes to sales, that comes in at basically 6%, and that's pretty much expected because Tesla, for the most part, is a business-to-consumer firm. This could change in the future. Hopefully it does, and they sell more fleets to other businesses, which could give more volume to their sales. And for debt over capitalization, this is 33% of their enterprise value is debt, and I think that's a good place for Tesla to be right now to help leverage the company because they've got a great idea and they might not have all the cash that they need right now. So I'm okay with that as well. I gave Tesla an 8 out of 10 for a competitive advantage. They have first movers advantage, which obviously can be an advantage, and it can also be a disadvantage because you can put on all the hard work, research and development, and then someone in second place can just take it from you and use it to their benefit as well. But I think Tesla is so far ahead of technology and experience when it comes to electric vehicles. I don't know of anyone else that comes close to their experience and reputation. So I think they truly do have an advantage when it comes to first movers advantage. Another reason I gave them an 8 out of 10, which is rather high, is economies of scope when it comes to their green energy storage, batteries for solar panels, cars. So you've got some similarities there and can help cut costs and just make it a more efficient company and have a little bit of diversity while still having a pretty strong core. My favorite thing about Tesla as a customer would be they have a unique model of car servicing. They actually own and operate the dealerships and the servicing as well. This gives them an advantage of finding out what's going wrong with their vehicles, if there is anything going wrong quickly, and they can quickly fix it. Also, they're more incentivized as the dealership, if they're owned by Tesla, to treat the customer right, which I've heard horror stories from other car dealership companies that the service is not necessarily the best. Tesla is also known for coming to your house and servicing your car there, which I think is a great idea too. They've got positive free cash flow for the past 2 years. That's huge for me. I see that staying positive. So that's another reason that I gave them the 8. Human resources, I think they're great in that category as well. I believe Tesla attracts high-quality people due to their reputation and their mission to move the world to a green energy model. Elon Musk is big into artificial intelligence when it comes to driving, so I think they also have an advantage in that. This could be huge for profits and free cash flow in the future. If you're wondering why I didn't give them a 10, other than I've never given anyone a 10, it comes down to I mentioned earlier with the first mover advantage. You've got General Motors, Ford, and Toyota. All the other huge car manufacturers could hop in here and focus on the green energy, and it would be tough for Tesla to compete with them, but I'm not too worried about it. That's just one of the few disadvantages I could think of. For income growth rates for the past 3 years, out of all the ones that we measure for, there are actually only 4 that were consistently positive over all 3 years to give us an actual compounded annual growth rate. The operating cash flow is where free cash flow directly comes from. All you need to do is subtract capital expenditures from that, and that's at 68%. So that's a good sign for free cash flow. You've got EBITDA right above it, which is another popular financial measurement for cash flow. They're both basically the same thing, 69% versus 68%. I don't list the growth rates for expenditures, but I do calculate them in my analysis, and operating cash flow is growing at 68%, whereas CapEx is growing at 22.58% for the past 3 years. So just think about that. In the future, the free cash flow is going to be growing at an even quicker rate. And even the 2 lowest growth rates are still above 20%. Revenue is kind of alarming, to be honest with you, being that low, but I think the revenue is there, and I think it'll continue growing at that rate. But I think costs are going to be becoming so much lower with hopefully a higher supply of materials for Tesla. They're creating some deals with some smaller companies when it comes to lithium. I think the gross revenue is going to increase because the gross margin was so low that there's so much room for growth when it comes to profitability. Here is the present value per share greatest to least table that I always put in the presentations. I usually put all of the income metrics in here, but like I said earlier, I didn't have 3 years of positive metrics for all of these forms of income, and I didn't even have 3 years of positive free cash flow. I only had 2 years, but I took the 2-year compounded annual growth rate, which was 158%, just to see if they could theoretically maintain that amazing growth rate. They would be worth an intrinsic value at a 12% discount rate of $148,631 per share. That's ridiculous. That's most likely not going to happen. I think the other present value per share metrics are more realistic. I honestly like the EBITDA here. I think it's a good median if you take out the free cash flow, which I just put in there for kicks and giggles. As I mentioned earlier, the revenue is lower than EBITDA and operating cash flow, and that's just because the EBITDA and operating cash flow have a ridiculous compounded annual growth rate right now, and gross revenue is the lowest. And like I also hinted at earlier, there's an 8 Tesla for the past 3 years. Their average gross margin is 18.8%. So that's more than 80% of cost of goods sold that they can improve upon to increase that gross revenue. So there's plenty of room to grow there, even though that revenue growth rate is still high, but it's the lowest growth rate I measured. Okay, now for the important part that everyone's been waiting for. For the base metric that I chose to use for using the actual values to apply the growth rates to, I chose free cash flow. I chose that because it is such a good metric when it comes to actual cash generating ability of the firm, and it's looking very likely that it will only be growing. I chose 48% as my optimistic growth rate to chill obviously quite a bit on the free cash flow growth rate of the past 2 years, and it's also the median of the 4 growth rates that we looked at earlier. Pessimistic growth rate of 10% is very conservative, and I chose this just in case the big car manufacturers come in, get really lucky, and just annihilate Tesla. This overall created a range of $72 to $670. The closer you can get to $72, the less risk and higher gains you are expected to receive, and vice versa for $670. Good luck getting Tesla for $72. I'm sure we had the opportunity years ago. You have to remember they just recently split as well, so I'm sure we had the chance. We just listened to the media too much and thought Tesla was going to go bankrupt. Even if you do pay the $670, I think that optimistic of 48% is pretty likely when it comes to free cash flow. So you might not get a huge return, but I think you would still get a 12% annual average gain. Thank you for watching all the way till the end. If you enjoyed the video, please like, subscribe, and even share with your friends if they're interested in investing. If you agree or disagree with my calculations, please let me know in the comments. If you have any more recommendations for stocks you would like me to value, please include that in the comments as well. Thank you for watching and go have fun investing.